Hi, everyone. We would now like to cover the key differences between Ind AS 103 business combinations versus the corresponding AS, the AS 14, which is, which we have dealt with under the intermediate level for amalgamations, right? Now, primarily, as we have all observed, that there is a considerable set of differences, right, between the earlier accounting within the AS framework, and now we are looking at, of course, the Ind AS 103. There were two key standards which dealt with the guidances for the business acquisition, which is AS 14 accounting for amalgamation, as well as AS 21, which is consolidated financial statements, right? Now we have, of course, 103, along with, I think we need to kind of look at Ind AS 110, which is consolidated financial statements as well, right? So that's something which is the key. Not something which is a very relevant distinction. It's all about looking at the specific standards wherein it is covered. Okay. The key differences within the AS framework versus the Ind AS framework. Primarily, when we looked at amalgamations, we talked about there are different types. We look at the amalgamation in the nature of purchase or amalgamation in the nature of merger, right? Where we talked about the purchase accounting, right? You would be recognizing the assets or liabilities at their existing carrying values. That was the norm earlier, right? You would simply add on the numbers and call it, for example, let's say an amalgamation, right? However, for the merger purposes, you would look at the pooling of interest method, wherein you look at, of course, everything is again recorded by the transferee company at the existing carrying values. That was primarily the categorization. But as far as the Ind AS is concerned, you look at the acquisition method as a rule of thumb, right? As a thumb rule, you would recognize the acquisition method. You recognize all the assets and liabilities at their fair values, right? You would look at the purchase consideration at the fair value. You would recognize also non-controlling interest at the fair value. Very specific aspects. We look at the common control transactions, what we dealt with. That's where the pooling of interest is applicable. Otherwise, it is prohibited. It is absolutely prohibited there. Okay. Normally, and under the AS framework, you would capitalize the acquisition related costs, but we dealt with that part. Any such costs of diligence, of consulting, or compliances, etc., they are simply charged to the P&L as and when they arise. Okay. AS in general have been a little more specific, but then the Ind AS is a bit more detailed, more comprehensive. We'll talk about many aspects, let's say, including in-process research and developments, wherein there is no guidance available, right? But when you look at the Ind AS framework, you would recognize those items to the extent they are identifiable. You recognize them at fair value, and then you follow the provisions of Ind AS 38, which is intangible assets, right? One key difference is basically about the recognition and the measurement of goodwill between AS and Ind AS framework, right? Any goodwill, which arises as far as the AS framework is concerned, that is subject to amortization, right? Which is not at all applicable as far as the Ind AS is concerned, right? And that is something which is something that you need to kind of consider well, right? As far as the recognition of goodwill or capital reserve is concerned, it's a similar treatment done even in the Ind AS, even as per the Ind AS there, right? Primarily for contingent consideration, they are included as a part of purchase consideration, right? But then, as far as the Ind AS is concerned, the recognition is done, of course, as a part of the purchase consideration, but at fair value. And then you talk about the subsequent measurement, where you look at the fair value through profit or loss criteria. Any changes in the value of the contingent consideration would be routed through statement of profit or loss. Okay. Similarly, any transactions between entities under common control, there is no clear guidance, but Ind AS 103 has all information such transactions between the entities there. Okay. Likewise, there is no specific guidance provided in the AS framework for the measurement period, but from India's 103's perspective, you would look at the changes possibly to be made. We talked about that provisional accounting, right? It can be done up to 1 year's time frame, wherein there is a possibility of changing the goodwill as well at a later point in time. Okay. Finally, for the business combinations achieved in stages, you would normally remeasure the equity on a step-by-step basis as far as the Ind AS or as far as the AS framework is concerned. But categorically, any equity interest would be assumed to be disposed of and brought back at its fair value with the changes recognized in the statement of profit or loss. Right? A small section, and that's what we wanted to cover here briefly. All right. Thank you very much.